We continue with our discussion on FRA Unit 4, and now that we are done with the basic construct and the basic headers of a balance sheet, we are going to get deeper in terms of our understanding of how do we analyze balance sheets, right? So there are two broad ways of analyzing balance sheets. The first one would be essentially trying and comparing it with respect to each other by kind of equating proportions that each header has with the balance sheet headers. And the second one would be try and finding out calculation of ratios for a couple of companies, right? So the first one is going to be similar to what we saw in the context of our ratios that we saw for the income statement, and that's called as the common size statements, right? And the second one would be when we talk about would be the balance sheet ratios, right? That's the more important analysis part as we look at. But broadly, we'll start with the first one, which is the simpler one, which is what are the common size statements that are available with us, right? So what do we mean by common size statements? That's exactly the same that what we saw in terms of the P&L. There's just one difference. In the P&L, everything is made as a percentage of the sales number. Here, because you have two sides to the balance sheet, each account header is expressed as a percentage of the value of either the assets or the liabilities. So every line item which is there in the balance sheet is basically expressed as a percentage of either total assets or total liabilities. Now this can allow easy analysis between companies or between time periods for the same company, right? So that becomes an important part. We are saying every header in terms of what is the proportion it has as a percentage of either total assets or total liabilities. Remember, assets and liabilities are going to be the same. So you could divide everything by total assets and you could divide everything by total liabilities, and that works fine. All you have to do is take each header divided by the assets number of that year, right, to get to the common size statement. So that's the broad construct of how do you look at common size statements. How do they become important? Let's take a generic example. Let's assume there's this company which has assets and liabilities which are given here, and we have, let's say, total assets 3250 and total liabilities are 3250, and we have different numbers that are there. These are just hypothetical numbers that are there. How do I find common size statements? So this 1900, every number has to be divided by the total assets number, right? So if I divide each of these numbers by the assets number, I get the number. And similarly here, I have to divide each of these numbers by the total liability number, each of these numbers by the total liability number of that year. So 1900 gets divided by 3250, and then 500 gets divided by 3250, and then 2500 gets divided by 3250, and so on and so forth. What that does is it gives us a sheet in this format. So if you divide 1900 by 3250, you will get 58.46%. If you divide 500 by 3250, you'll get about 15%. What does this tell us? It tells us that in the first year, out of the total assets that the firm has, nearly 58% of those assets came from cash. In the second year, however, most of those got used up, and this cash got deployed in terms of either inventory or in terms of receivables, right? So that's the broad analysis that you get in terms of how a company has progressed. And then in the third year, inventory again resulted in cash and receivables again resulted in cash. So the cash headers went up, right? The company also invested a little bit in terms of fixed assets in the third year. So that amount kind of went up, right? So basically we're trying to kind of gauge year on year what has happened with the firm. At the same time, we're also trying to gauge in case we want to compare this across companies for the same year, we could also find out which company has what ratios available, right? What kind of proportions with each of the headers. So a firm with higher cash numbers would probably be more stable. A firm with higher debt number will be unstable. So you could then start looking at individual characteristics and start comparing firms with respect to those common size statements, right? So let's look at an example now. So let's take the case of two pharma companies in India, Cipla and Aurobindo Pharma, right? So we have their total liabilities number, which is 2893 and 15699. We're going to divide and find the common size statements for both of these. So in the first case, we have to divide everything. So we have to divide by the 2893 number. So 2893. In the second case, we have to divide by 15699. Each of these headers needs to get divided by those respective numbers in order to arrive at what is the common size statement number, right? So that's what will become important here. Let's actually go to an Excel file and try and decode this and try and understand this, right? So here we go. We can just simply do a copy and paste of this here so that we know that we're trying to find this out. And all I do is I divide 161 by 2893 and I will freeze this number. And because I want to freeze only the row, not the column, when I shift it on the right side, I want to kind of move the cell or reference. So I do this, I drag it on the right side, just quickly check, that works fine, right? We drag it down and we quickly check, that works fine. We're dividing the same number, right? So all we do now is go back to home and convert this to percentages and add a decimal point and then quickly take it down all the way down till here. We remove all these items in between, which are basically spurious data because there's a blank there, right? And we find a broad understanding on where the firm stands, right? So what's the broad spectrum of the money that is there? So let's look at this in terms of the equity capital for Cipla. Nearly 57% of the total liabilities come from just share capital and reserves and surplus. That's lesser for Aurobindo, right? In terms of other liabilities, Aurobindo has a higher long-term debt, correct? Whereas if you look at trade payables, Aurobindo has a higher payable as well, and other current liabilities are also higher, correct, for Aurobindo. So basically when we look at these data points, it gives us a sense on trying to gauge where is a firm doing better and where is a firm not doing better than the comparative firm, right? So that gives an idea that long-term borrowings are probably higher as a percentage of the total assets for Aurobindo, right? So that gives us a broad sense that Aurobindo, so here Cipla scores better, but in terms of current liabilities, you find that there are bigger current liabilities, especially in terms of payables that are available for Aurobindo, right? So more payables for Aurobindo. We'll look at more details about how that is useful or not useful in due course of time. And we also have more debt for Aurobindo, correct? So that's the broad analysis that comes out of here in terms of the liabilities side of the balance sheet. Let's look at the asset side of the balance sheet for the same two firms. And again, in this case, we'll divide by 2893 and here we'll divide by 15699. That's the division numbers that we're going to look at. And we go back to our Excel file and we go further down on the sheet and we find that these are all the assets number that are there. We just quickly do the same. We divide the total tangible assets number by the 2893 number, freeze only the row and not the column, correct? Drag it here, convert it to percentages, and then drag it down all the way down to the total assets number, and then remove all the blank numbers in between. So the zeros here and the zeros here go away and this zero goes away, right? Now let's try and gauge the major differences. So we find this goodwill on consolidation, right? We've already seen what is a goodwill, right? Goodwill is basically if you have acquired another firm. So it seems Cipla has acquired another firm. So that's our first inference that comes out of here. You will see tangible assets. Intangible assets are fairly similar otherwise. There isn't too much of difference there. Aurobindo keeps higher inventories, and Aurobindo has a higher number of receivables as well as compared to Cipla. Cipla is better on both those accounts, right? So those are the other two information that come out of it, this entire analysis. So the first thing that comes is Cipla seems to have acquired some firm, and that's why the goodwill comes here. The second information comes about inventory and trade receivables, which is Aurobindo has higher inventory and receivables, right? And that's based on a proportion of the total numbers that are there in terms of total assets. So that's the example of how common size statements become useful, where we can go ahead and look at the statements of the two companies, try and compare these statements, and then make definitive claims about which company is doing better than the other. Now, some of these don't give you a direct answer on whether it is right or wrong, but it does give you a sense on how the company is stacked up against some competition, right? So within this case, these are two pharma companies. We find that the first firm, Cipla, has lesser debt. It has lesser payables. It also has lesser inventory and lesser receivables. And at the same time, it has some goodwill on consolidation, which is if you see a fair chunk of the balance sheet size. So if you actually look at this balance sheet size, nearly 25% of balance sheet is goodwill. Now that's interesting because obviously they paid this 5,500 crore extra, right? Cipla paid 5,500 crore extra while purchasing something, right? Now think about it. If the company closes the business today, they will sell assets to pay liabilities, correct? Now in the case of Aurobindo, all the assets are basically tangible assets. You know what those are. In the case of Cipla, however, if you sell the assets, this to realize 20,893, it is important that you also realize this 5,500 crore, which means whatever this asset is, this asset needs to sell at the same price that incorporates 5,500 crore as extra value. So unless that happens, this 5,500 will not get realized. If that doesn't get realized, you will not be able to repay all your liabilities, correct? Aurobindo is safer that way. So even though some of the numbers are higher in terms of payables and receivables and inventory and debt, right? There is no goodwill, and to that extent, it is safer when you look at the overall construct of how do you go about analyzing companies. That's a classic example of how common size statements could be useful, and how you could try and derive information out of common size statements when you look at companies in the same sector typically, right? So that's about common size statements. That basically brings us to close to an end of this particular session. A couple of questions as we end this particular section. What is the difference between common size statements for P&L and the balance sheet? Is there any difference? And can you calculate the common size statements for the following firm? The data is simple for this firm. Total liability is 1,500, total assets of 1,500 divided between these numbers. So as a hint, you just have to divide all these numbers by the total liabilities and divide all these numbers by the total assets, and you will get your answer, right? So that's about common size statements. That is one way of analyzing the financial statements of a company, a balance sheet of a company with either its history or with its peers. Thank you.